Good morning and welcome to Armanino's webinar, Demystifying Valuations for Venture-Backed Companies. My name is Mary Tressel and we're happy to have you with us. We are going to start the webinar by explaining how to use your webinar pane. So in the upper right-hand corner of your screen, you will see an orange arrow. To modify that and expand that, please click on the orange arrow and you'll see that there is room for you to enter in questions for our presenters. We will answer those questions as time permits at the end of the webinar, but you can send in a question at any point during the webinar. And if we run out of time, we will make sure we get a response to you by email following the webinar today. Secondly, we want to make sure that you have your audio settings set correctly. If you've called in on your telephone, please click the telephone button. If you're using a mic and speakers on your laptop, please click that button. This will help eliminate the echo sound. And finally, to qualify for CE today, you must be using a personal computer and log in with your own information and unique URL. Must be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions and complete our evaluation survey at the end of the webinar. We will send you a certificate, a link to a certificate and to the slides and recorded presentation within 3 business days after today's webinar. And with that, we're going to have our first of our presenters here. So Alex Floria is an account executive with Armanino's Valuation and Equity Management Solutions Group. He's spent the bulk of his 22-year career in financial services, mostly around Silicon Valley, and he possesses the ability to analyze and ascertain the needs of each client and then present complex solutions in a simple, easy to understand fashion.
Good morning, everyone. This is Alex Floria. I wanted to introduce my colleagues for the presentation today. First is Dirk van Dijk, and Dirk has been doing valuations for over 22 years. He's valued over 1,000 companies, and he also leads our audit review team. Next is Nadia Carey. Nadia is a manager with Armanino, and one of the very interesting things that Nadia does is the SFAS 73 audit reviews, in addition to valuations. And what that is when our audit clients come back with their client's 409A report, Nadia gets to review it, ask questions, and occasionally poke holes into the reports. Lastly, my good friend Gunter Hoffman. Gunter has valued over 400 companies for investment, M&A, and financial reporting purposes. One of the interesting things Gunter also does is he leads Armanino's corporate finance group. So we get to see quite a few deals and some interesting companies out there when Gunter brings them in.
All right, and then today during our webinar, you'll learn how to discern between valuations for tax and financial reporting purposes, define the requirements under AICPA and the IRS, calculate the cost of non-compliance, review the valuation process and methodologies, and identify common methods for value allocation for preferred and common stock.
Okay, so just to go over the presentation, we're going to first address regulation and compliance issues. Next, in the second part, we'll go over methods and approaches for valuations. And there's a third part that deals with similar topics. That's on valuations, except we get down into allocation. A little bit about the scope of our team's experience. Obviously, we get involved in lots of 409A reports, so compliance for RC 409A and 718. But we also get to do valuations for gift and estate, for transactions, portfolio valuations, so ASC 820, purchase price allocations, and derivative valuations. We act as purchaser rep and get involved in corporate finance and M&A transactions. We've done over 3,000 valuations for over 1,000 clients. On our team, we have 15 professionals, most with advanced degrees and certifications.
And with that, we're going to turn it over to Dirk van Dyke. Thank you.
Okay, so part of the theme here is there's two standards of value when you do a valuation. There's tax standard of value, which is fair market value. That's applicable to both 409A valuations for common stock valuations to price stock options, and for estate and gift valuations. It's the exact same standard of value. Auditor, as it says there, is for fair value purposes. We better say financial reporting purposes. So there's a variety of reasons for that, including 718 is expense calculations for equity, which we have a separate group here that does that. Then there's ASC 805, 360, 350, purchase price allocation, and testing for goodwill impairment for impairment for goodwill and for long-lived intangible assets. Okay, Section 409A was added to the Internal Revenue Code a long time ago and really was implemented in about 2006, 2007. And when it says non-discounted stock options, that means that doesn't mean you shouldn't apply discount to the common stock value. It means that stock options that are granted at or above the value of the common stock. Any companies issuing a stock option or stock appreciation rights need to comply with this tax code. Okay, so this should be done at least annually or more frequently if a significant event has occurred, such as a new financing round, certain arm's length transactions in stock, that's in the common stock itself, if the buyer is knowledgeable specifically, and if there are any big developments that would result in a change in value, a major change in value to the company's forecast, which would, of course, if that increases a lot, then the value of the company would increase a lot. It's also done when the value has gone down quite a bit for companies that wish to issue stock options at a lower price. Okay, if a company loses a big customer, and we saw a lot of that in 2008 and more in 2009, where because of the major financial crisis and the Great Recession, many companies had their stock prices decrease substantially. So a number of those issued revised stock options at a much lower price for employee retention purposes. Okay, so to be in compliance with 409A, to avoid taxes and tax penalties, the exercise price of the stock option needs to be greater than or equal to, it's almost always set equal to fair market value of the underlying stock. So what most board directors do is they take a safe harbor provision and hire, the first bullet point there, hire an independent appraisal firm to do the valuation. And as you can see, that's supposed to be within 12 months of the date, and it's also supposed to be more than that if there's some major event that would increase the value of the company I mentioned before. There's two other cases that are generally not used. A repurchase formula is occasionally used, but that has to be used for every single transaction, every single purpose, every transaction of the stock. The IRS does have the right to rebut such a presumption, but has to show that either the valuation methods or application of methods was grossly unreasonable. The key point here is that if you hire an independent valuation firm to do your valuation, it puts the standard of proof on the IRS to prove that it was grossly unreasonable, which is a very high bar to cross. That's as opposed to a company that does its own valuation and sets the price. Then the company has to prove that it's a reasonable valuation. That's a much easier for the IRS to attack. As you can see here, these are some of the key factors that are taken into account. Typically, future cash flows, and market value of stock or equity interest in similar corporations, and transactions in the company's own stocks are the key factors taken into consideration. Unless it would be an asset holding company, then we'd look at the value of the assets. And there's other factors that we take into account as well, as you can see below. Okay, so here's why most companies these days are hiring independent appraisers to avoid these adverse tax consequences. So that occur when stock options are issued below the fair market value of common stock at the date of the grant. So let's say at a later date, the IRS comes in and proves that the value was $1 a share for the common stock, but the options were granted at 10 cents a share. So on that difference in value, there would be a 20% additional tax on underpayment at the time of vesting. That also includes the value of the common stock at the time of vesting. I think we have an example of that later on, which makes things even worse. There's a case there. You can see the IRS is, in fact, starting to assess 409A penalties. In addition, the state of California imposes a 5% tax plus interest. The bottom line here is that with federal and state income taxes and penalties and interest, the recipient can end up receiving less than 1/5 of the proceeds they would have received had a common stock valuation been done by an independent appraiser. Okay, here's the example. So the strike price at the time of grant is $5 per share. The fair market value at the time of grant is $7 per share. Here's an interesting thing that shocked me. The fair market value at the time of the exercise is $10 a share. So as you can see, if you go down to the taxable income, is the difference between the fair market value and the time of the stock exercise, the $10 a share, minus the strike price, minus what the option price was. And that can end up being a huge amount, a huge difference. If you wait till a company goes public, you could have a strike price of $1 and the public company stock price could be $20 and up. Even if the fair market value at the time of the grant was only $1 or $2 greater than what the common stock options are priced at, you could end up with a huge tax burden. And then jumping down to the bottom in this example, the very last bullet point, the most the grantee will receive from this is 21.7% of the appreciation. So that's not what the employees want. I can imagine some pretty unhappy employees in this circumstance. Okay, now moving on to the next slide. Okay, so stock options are also expense for financial reporting purposes. Any company that's audited has to comply with ASC 718, formerly 123R, which you may be more familiar with. So the cost resulting from share-based payment has to be recognized in the financial statements and recognized at fair value. And I think later on we'll discuss the difference between fair value for accounting purposes, for financial reporting purposes, and fair market value for tax purposes. Okay, so as I say, we here at Armanino have a separate group that does this, but in the case of plain vanilla options, of your typical stock options, it's fairly straightforward. You have the share price at the grant date, you have the exercise price, historical volatility, that's of public companies. You also would take a look at sometimes the implied volatility of the comparable public company data set, because privately held companies don't have a lot of data in terms of the volatility of their stock price, because they don't trade, obviously. The legal term, the contractual term of the option, and the risk-free interest rate. These are amortized over the vesting period. Typically, that's a 4-year period or a 3-year period. And one thing I'm not familiar with, but is taken into account, are the expected, can be taken into account, are the expected the expected number of shares that are expected to be forfeited or lost per year because someone leaves the company. If you leave the company, you have typically about 90 days to exercise the options or you lose them. Here is a key document if you're interested in what the factors are that should be taken into consideration. The AICPA Accounting and Valuation Guide. You can see the name up there. This has the best practices for what should be taken into account in the valuation of common stock issued as compensation. Final was issued in 2013. It's available on the AICPA website if you're interested. Again, this complies to all companies issuing GAAP financial statements. They need to value at each grant date for anyone that receives this, employees or non-employee directors, and they need to value at each reporting period. So for privately held companies, that's typically end of the fiscal year. For publicly traded companies, that's once a quarter. Again, that's how often to expense is the same thing. Okay, here we are. What's the difference between fair market value for tax purposes and fair value? Fair market value is defined by Revenue Ruling 5960, which I studied extensively when I first started doing valuations. And we have our staff study that too. And then fair value is defined by an account by the FASB in ASC 820. One of the biggest differences, I'm going to jump down that lower part of the slide, is that there's a minority discount. That is, there's a discount for lack of control that is applicable for tax purposes that's generally discouraged for financial reporting purposes. The powers that be at the SEC have decided that they don't like control discounts for lack of control for whatever reason. So typically for financial reporting purposes, those are not used. I guess the SEC doesn't like them because typically when they look at a company, they're about to go public, and there is no difference between a controlling interest and a minority interest. If you go public, all the shares go public at the same price. For privately held companies, that's not the case. And now moving on to our next polling question.
Yeah, our very first polling question. So again, we need you to participate in order to get your continuing education credit. So that question is, a company would only need to have a 409A valuation performed if it is on the IPO track. Is that true, false, or are you unsure? So we're going to give folks a moment or two to consider that and register their answer. I think it's a trick question. So we've got a few of you voted. Please go ahead and make that selection, either true or false or not sure. And then we will close the poll and share your votes with us, and then have Dirk give us the correct answer.
Okay, so a large majority got the correct answer of false. Any company granting stock options or stock appreciation rights, even if they have no plans to go public, need to get a 409A valuation. We've seen companies, we were talking with a partner in a law firm that works for a lot of companies that do acquisitions. So they work for companies that they are hired by companies that are in acquisition mode. And if they come across the company, if their client comes across a company that has not had 409A valuations done, they've seen that both delay the deal significantly, and in at least one case, pretty much the potential buyer walked away from the company because they did not have a 409A valuation. The buyer did not want the liabilities associated with that. So pretty much any company that plans on being successful, plans on having a successful liquidity event, whether it's an M&A or an IPO, should be getting a 409A valuation.
All right. Hi, everybody. I'm Nadia Carey, and I will be taking you through the enterprise valuation piece of 409A valuations. Here's an overview of the process. We divided this out into 4 pieces. So the first step is to define the engagement. For a 409A valuation, we're typically valuing 1 share of common stock at fair market value for the IRS and fair value for ASC 718. So then we have qualitative and analytical quantitative analysis that we do. And I want to highlight the qualitative piece here. We obviously get a lot of documents from the clients, and we review their financial statements and legal documents, but it's always necessary to sit down and have a conversation with management and find out what the major risks are and what the opportunities for the company, what are the competitive advantages and disadvantages. So once we get this foundation, we proceed into our valuation analysis, which is in the last column, and this is what we'll be going over for the rest of the webinar. So here's a high-level overview of how we do the valuations. The first step is to value 100% of the company. We do this through 3 primary approaches: the income, asset, and market approach. Once we get to that enterprise level 100% value of the company, we will allocate it amongst all of the securities that are held within the company. So this includes preferred stock, common stock, options, and warrants, and what have you. There's a few different approaches to do the allocation piece, and these are defined in the AICPA valuation guide. So typically in a lot of these valuation methods, the preferred shares, given their liquidation preferences and preferential rights, actually end up getting allocated more value than the common stock that we value for 409A purposes. So once this is done, we get to our share level value of common stock. So once we get to that share level value of common stock, there's a variety of discounts that could be applicable. And in the bottom right-hand side of the slide, you can see the basis for a 409A valuation, which is non-marketable and minority. So as Dirk mentioned just a few minutes ago, the control discounts really aren't taken for a 409A valuation. But this does leave a marketability discount that is applicable after we do the allocation piece and we get to our share level value. We would almost always apply a marketability discount to the value of common stock per share. So here's an overview of issues for venture-backed companies. First, we have the stages of the life cycle of a private company, and these are outlined in the AICPA valuation guide. It goes from startup, 2 guys in a garage, to getting early revenue, all the way through a mature company ready for a successful exit via IPO or M&A. Along with these stages, the guide sort of outlines which valuation methodology and approaches are appropriate to apply to companies in each of these stages, and which approaches are appropriate as the company proceeds through these stages. So as it happens frequently with 409A valuations, the later stage the company gets, the more complex the capital structure becomes. Investors, start in early. It could be just friends and family, but as more and more sophisticated investors start putting their money into the company, the equity structure can become quite complex. And this is where oftentimes we've seen derivative instruments come up that sometimes require a separate valuation on their own. So here are some qualitative factors that we analyze when doing a valuation. It's very important to get this information from management, from our research, just doing independent research online or industry websites. So we want to find out what milestones the company has achieved thus far as of the valuation date and what milestones are on the horizon. It's important to look at who the members of management are and who the major investors are. Sometimes there could be a very strategic relationship there, and that could give a company quite a significant competitive advantage compared to other companies its size or other startup companies, and this does impact the valuation. Other strategic relationships include those with suppliers, who we look at who the customers are, and any proprietary technology that perhaps they could license out or whatnot. All of these are very unique factors that really vary from company to company. Externally, we look at the economy and what, if any, impact that the economy will have on the company's business, as well as industry conditions. And risk factors, obviously, is a big one that we look at, external risk factors. So now we will get into the three main approaches, and we'll do this from the perspective of 409A valuations, but there are a variety of valuations, as we mentioned, gift and estate tax and whatnot, that will utilize some other approaches more than 409A valuations. So in the income approach, for a 409A, we're usually using the discounted cash flow method. And this is a forward-looking income approach where management basically gives us a forecast, and we do a valuation based on forecast financial statements. The capitalization of earnings method is a historical-looking method and is more appropriate for stable companies that are growing slowly. Within the market approach, there are three main methods: the Guideline public company method, the Guideline M&A method, and the recent transactions in the company's stock method. The public company method is very common for 409A valuations, and the recent transactions in the company's stock method is also very common for 409A valuations. The Guideline M&A method is common, and where relevant, is used when relevant, but often as maybe a supporting method. Lastly, we have the asset approach. This is really used for early stage companies that just haven't had a lot of financial progress, and that maybe it's too early to provide a full forecast. It's also appropriate for asset holding companies, but typically those companies do not need a 409A valuation. Okay, so here's a slide that goes over the discounted cash flow analysis. Basically, we get a forecast from the client, and depending on how much visibility they have, they'll provide maybe 3 years at a minimum and up to 5 years, or we've had companies provide very long-term forecasts, up to 10 years or so. So we'll take these forecasted financial statements and basically discount back to present value all of these forecasted earnings. And that's one piece of the valuation. The other piece is at the end of the forecast, there's a hypothetical terminal value, which represents the value of 100% of the company at the end of the forecast period. For early stage companies, oftentimes the terminal value at the end of the forecast really comprises most of the value of the company. For those that have made a lot of progress, maybe it would be less so, but pretty often the terminal value is most of the value of the company. The terminal value, so it can be calculated a couple different ways. Oftentimes for a 409A, it's using a public company multiple. It can also be calculated using the Gordon growth model or the H model. Another key input into the discounted cash flow method is the discount rate. This represents the level of risk that is applicable to the forecasted cash flows. If management provides very aggressive projections, then perhaps the discount rate, it would be very high. And likewise, if the projections are very conservative, then a lower discount rate may be appropriate. So continuing on with the discount rate, conversation. We have outlined here the different stages on the left of the company's life cycle. So in startup phase, this top line, you can see the discount rates are very high. And these are studies that have been done on venture-backed companies and investments in venture-backed companies. So as the chart progresses down and to the right, the discount rates become much lower once the company gets to a mezzanine IPO profitable stage. So here are some issues that arise in the discounted cash flow analysis. I mentioned unrealistic or realistic forecasts, and this is often one of the most crucial items to really speculate upon and analyze. Sometimes with early stage companies, management is not as advanced as large companies have very advanced CFOs and financial teams. So studying the forecast for reasonableness is very important to properly apply the discounted cash flow method and to get to reasonable valuation results.
And one comment that if a company has recently received a financing, we always make sure we ask to receive the same projections that were provided to investors. Early on in 409A, I received projections and didn't realize that they were about half. So the revenues were 50% lower than the projections that the investors had been provided to in a capital raise 3 months earlier. So one of the first questions I got from the auditor was, why didn't you use the projections provided to investors? And I said, well, I thought I had, but the management had reduced the projections by 50%, and management had a very difficult time explaining to the auditors why, and justifying why the revenues would drop 50% over a period of 3 months.
Yeah, Dirk is absolutely right. It is a very crucial piece, and these forecasts should tie to those given to the investors. And as an audit firm, we do review a lot of these 409A reports. And sometimes the certain 409A providers aren't as aware that as an auditor, you really get access to a lot of information and a lot of documents. So they should be aware. And the forecast should be coherent with the ones provided to investors. Other issues on here, the model assumes a constant cost of capital throughout the projection period and the terminal year, and this could be adjusted for. Typically it isn't, but you could apply different discount rates to varying years or varying revenue streams. It typically does not include dilutive effects of future capital raises, and oftentimes additional modeling is needed to adequately consider tax benefits of the company. All right, moving on to the market approach. So we went over the 3 basic methods. So there's the public company method and the guideline transaction method. These both use multiples to value the subject company in the 409A valuation. The third method on here is a recent transaction in the company's stock. So there's usually 2 ways of looking at this approach, and it is very common to see this in a 409A valuation since they're getting a lot of investment all the time. So the preferred stock transactions usually uses a back solve method, and this is described in the AICPA guide, and we'll go over it a little in just a few slides. The other recent transactions are common stock transactions. These certainly should be considered in the 409A analysis, and care should be given to support why or why not any recent common stock transactions are good valuation indicators or not. So in selecting the guideline public companies, the 409A provider should really take a lot of effort to select a good set of public companies that's reasonably comparable to the 409A, to the company getting the 409A. Here we have some criteria. So they should be in the same industry, sell into the same markets, have a similar level of risk. This is very difficult. If it's a very early stage company, they're not going to have the same level of risk. But so what else? Management, size as measured by revenues. So maybe exclude the largest large cap companies, even if they're in the same industry. There's a lot of like smaller software companies, for example, that are more appropriate to use than some giant Oracle or something. Additional factors here are listed at the bottom of the slide. So there should be some support and write-up in the report as to why the certain public companies were selected. And here's a slide that goes over the selection of the multiple. And there's a large variety of multiples that you could use. Oftentimes in a 409A, we're using a revenue multiple because early stage companies are oftentimes not profitable. When selecting a revenue multiple, for example, there's a lot of criteria that should factor into the selected multiple ultimately, and these include possible adjustments for size, growth, profitability, and risk. And these really, you want to study these in comparison. So we're comparing the Guideline public companies to maybe a smaller private company. So if this small company is projecting a lot of revenue growth, then maybe there should be an adjustment to the multiple, given that a lot of public companies don't project really high revenue growth rates anymore. And there's some other selection criteria at the bottom left hand of the slide. And there should also be write-up in the report supporting the selected multiple. Here's an overview of the asset approach. It's really only used for early stage companies, and anything past a stage 2, really other methods should be used. So here's the outline of the stages in the AICPA guide and when the approaches are appropriate and which allocation methods are appropriate.
Okay, thank you very much, Nadia. We're going to do our second polling question. So we'd like the audience to respond to this. Given that the information on public companies are readily available, the Guideline public company method is preferred. So is that true, false, or you're not sure? And at this time, I'd like to remind you too, as you're responding to this, you can enter in questions using your webinar Pane, and you can enter those in throughout the webinar. So if a topic comes up and you're not sure and you want some clarification, make sure to go ahead and enter in those questions and we will answer them at the end. So it looks like we have a good group who has responded. We're going to go ahead and close that poll. And the audience is mostly weighing in on true, and the answer would be?
The answer is actually false. The Guideline public company method is a common method used. However, it's not necessarily preferred given the unique nature of each valuation. It's very situational which methods are used.
Great. Okay, thank you, Nadia.
So here's an example we have put together on doing an enterprise valuation. We have the summary of this company here. We're doing a valuation as of 12/31, and they have received Series A financing. We can go to the next slide. So here's their financial plan. You can see on the right, they're just getting started, still losing money, and then going to the left, they're growing and become profitable. Here's the example cap table. Common stock still comprises 40% of the company. They have Series A, and the option pool is 20% of the company. So here's an example set of Guideline public companies. The selected multiple is in the lower right. And in the comparison here, we've listed the New Design Inc., the subject company's revenue growth forecast down at the bottom. So they're projecting 77% in 2016. That's much higher than anything in the public companies set. So conversely, they're also projecting to take a loss next year with a 27% negative EBIT margin, and that is significantly lower. So in this case, we've selected the median multiple. Here's an example income approach. You can see that the terminal value is circled up in the upper left-hand corner of the slide. It's 70 million. Discounted back to present value, it's 17.9 million. And down at the bottom is our valuation result at 17.6 million. So really the terminal value was just offset by the projected losses. And here's our example market approach. We apply the same multiple to last 12 months projected revenues, and we achieve a valuation result this way. So in this case, we're weighting the income and market approach evenly here, and care should be given into the appropriate selection of the weighting. It's a good idea. It's a good when the two approaches come out similar to each other at a similar level.
Okay. So Nadia ran through those examples, and we have our next polling question. So if the subject company is young and fast growing, the best valuation method to apply is the market approach, the income approach, the Monte Carlo simulation, the back solve method, or a combination of A and B. So again, we've got a few people who have voted. We want to encourage everyone to make sure that you put in your answers so that you get the CE credit that you are looking for. This sounds like a tough question to know the right answer to.
It's a little bit of a trick question.
Yeah.
Don't give it away.
Sorry.
So we'll give you just a moment or two more just to register your vote. Again, you're not being penalized if you have a wrong answer. We just want to make sure everybody registers and shows that they are active in the webinar. All right, with that, we'll close the poll. And we have a variety of answers. We got the income approach, the back solve method, and a combination of A and B are all popular.
I think the majority of the audience actually got this correct. The answer is either D or E. So all three of these, really, the back solve method, the income, and market approach are all appropriate methods.
The back solve, of course, being contingent upon there being a recent transaction that can be used to do the back solve method with.
And with that, I'll hand it over to Gunther.
Hello, everybody. This is Gunther Hoffmann, and I will be talking about the methods and approaches for the allocation. So what that means is now we know what the whole company is worth, so we know what the cake is worth. Now we get to figure out who is going to eat it. In these early stage companies, there's usually preferred and common stock, and preferred stock is called preferred for a reason. It has a lot of additional rights and preferences over the common stock. And most of these rights, a long document list, are meaningful and substantive, but not all of them are readily and objectively measurable. So the question is, what's the value of a board seat? All the venture capital investors want one, but we don't know how much they would be paying for it. So we can't readily measure that. And then the third column here is, do the allocation methods consider these rights? And again, not even all of the measurable rights are easily be used in these allocation methods. So, for example, the anti-dilution right, well, I guess it is measurable, but it would be very complex. So it's complex means it's very expensive. So in the realm of 49A, usually it's not measured. So how do we allocate this enterprise level value to the different classes? There's three common methods. That's the current value method, the option pricing method, and the probability weighted expected return method, or short PWORM. There's a couple of others: Monte Carlo simulation, real option models, lattice models. They're not that often used in 49A valuations. Reason being they are more complex, meaning they're more expensive. First up is the current value method. That's really how most of us would think about an allocation. It assumes a distribution as of the date of value. So if we sell the company today, who gets what? And we show that in an example on the next slide. So Nadia calculated the company is worth 17.4 million, or 38. If we sell that company today, then the preferred stock, they eat their piece of cake first. So they get 15 million, leaves 2.4 million. In this case, we divide by 25 million shares because the preferred stock are fully participating, so they're double dipping. So they get their 15 million liquidation preference, and they also get a piece of the 2.4 million. Big slice of cake there. So that comes out at 10 cents per share. We take a marketability discount of 30% here, which is just an assumption. There's a whole other webinar how to come up with these marketability discounts, and that gives us 7 cents per share of common stock. The next allocation method is really the allocation method that's used in the vast majority of these valuations. Is the option pricing method. And that treats the common stock and the preferred stock as call options on the enterprise market value of equity based on the liquidation preference of the preferred stock. So that sounds like a handful, so we thought it might be easier to put that into a graph. So here's a payout function. On the x-axis is the total exit proceeds. So that's what the company would be selling for. And then on the y-axis, so on the vertical axis, is the payout. So that's who gets what from the exit proceeds. Below 15 million, everything goes to the preferred stock. That's the blue line. And then the common stock, they participate above 15 million, and they get 40% of those proceeds. So on the next slide, we show how that would look like in a current value allocation. So here the company is worth 17.4 million. If we sell it today, then the preferred stock, they get their 15 million. And then on top of that, they get 40% of the 2.4 million. So they get a total of 16 million. And then the common stock and the stock options, they get the crumbs of the cake. They get rather small slices. So what we really want to know is what the common stock get, right? Because we are valuing the common stock. So we reinterpret ownership of the company as the right to receive proceeds from a future sale of the company. So if I own 100% of the company, then basically that's the right to get whatever the company sells for in a couple of years. And I know the company is worth 17.4 million, so I know this right to receive future proceeds is worth 17.4 million. And we can slice this right up into two distinct rights. We can slice it up into the right to receive proceeds from a sale of the company for less than 15 million. And the common stock, they don't participate in that. That goes to the preferred stock. And then we can slice it up into the right to receive proceeds from a sale of the company for more than 15 million. And that is really the specific right that we are interested in, because this is where the common stock get 40% of the value of that right. So let's take a closer look at this right B, the right to receive proceeds above 15 million. So this is the payout function. Below 15, they don't get anything. Above 15, they get a payout, and common stock get 40% of the proceeds. So they get 40% of the value of this specific right. So the question is, well, how do we calculate the value of this specific right? And if we look at the payout function, it looks just like a call option. And a call option is, yeah, go ahead. For a call option, there's established methods to calculate the value of those. We can use a Black-Scholes or a lattice model. Usually Black-Scholes is used because it's a closed form model, so it's formula based. And all we need is the strike price, and that's the 50 million liquidation preference. We need the value of the underlying security. That's the 17.4 million. That's what Nadia calculated. We need a term to maturity. That's usually interpreted as the time to liquidity. So when the company gets sold, maybe in 2, 3, 5 years. Volatility we get from guideline companies, and risk-free rate we get from the Fed. That's usually the government bond with same maturity. So as an example, on the next slide, here on the top we have the right A and the right B. The right B, that's really the right we're interested in, and we see that's worth 8.5 million. So if the company today is worth 17.4 million, then the right to receive proceeds above 15 million within 3 years, that's our time to liquidity, that's worth 8.5 million. So about half of what the company is worth. And then on the bottom, the common stock get 40% of that because they have 40% of the capitalization. So their total piece of the right is worth 3.4 million divided by 10 million shares of common stock. It's 34 cents minus the marketability discount is 24 cents. So that would be our result from the option pricing allocation method.
Now, those of you who remember the value common received from the prior method, the current value method was just 7 cents a share. So the value common receives from the option pricing method is always greater than the value received from the current value method.
Yeah. So in other words, the value of hope is springs eternal. Another method here is the recent transaction method, and that's often called in auditor speak the backsolve method. And that reconciles this option pricing allocation method that we just talked about to a recent transaction, if there is a recent transaction. So if we actually go back one slide, we see here on the bottom that we don't only calculate the value for the common stock, but also for the Series A. And here on the bottom, we see the Series A here is worth $1.23. Now we know they paid $1.50. So the question is, what would we have to plug in as enterprise level value here on the bottom on the top left to get $1.50 down for the Series A? So we calculated that on the next slide. Next one. Yeah, here. So outcome is $1.50 on the bottom right for the preferred. And we get that result by 22.7 million, which then again allocates 36 cents to the common stock. So then on the next slide, when do we apply this method? Really, when there's an arm's length transaction in the preferred stock in proximity to the date of value. We would apply it with caution if it's too long ago, maybe that indicator is stale. If it was an inside round, maybe that was a self-serving inside round, or maybe that was a round to protect the interest. The insiders have little interest to dilute themselves, so there's no economic benefit usually to take a down round if it's inside. If it's a strategic investment, there might be other consideration. If there's a comprehensive agreement, so if there's warrants and other contracts, then also apply it with caution. On the other side, there's also, this of course doesn't take into account control characteristics or the underlying probability distribution. Comes to the last allocation method, that's the probability weighted expected return method, and that technically calculates possible future scenarios, or I would say likely future scenarios, like an IPO and M&A. And then for specifically these scenarios calculates who gets what, and then we discount that to today's value. So here is an example with 4 scenarios with a probability weighting and then a discounting and weighting back to today's value. This comes out at $1.09. So there's a wide variety depending on which method we're using. So I guess the takeaway is it really depends, of course. In each case, there's different assumptions, and different stages would require different allocation methods. When do we use which one? Honestly, option pricing method is used in 80 to 90% of these valuations for 49A. Current value method is really only used if a transaction is imminent. Probability weighted expected return method is used when there's some visibility into an exit. So usually 12 to 24 months before an exit. And that gets us to our last polling question.
That is correct. So we want to make sure that you answer this one as well to get your CE credit. So the last question is, what are the consequences of not complying to 409A IRC standards? Is there a penalty tax on the employees, a tax on the company? Option C is both A and B, none of the above, or you're not sure. So we've got a good amount of the group voting in on this, and it seems like the answers for most of them are going correctly here. So we're going to go ahead and close that poll. And Gunter, how did they do?
Well, I guess most of them are right. This is C, A, and B are right. So there's a penalty tax on employees, and there's a tax on the company. And in reality, we would expect that the employees turn around and talk to the company and say, well, gee, you told us this was the fair market value, so how is it my fault? You should make me whole. And so the burden also comes back that way, back to the company.
I had wanted to add a potential answer, which was a very unhappy board of directors, but I was voted down.
Unhappy investors.
All right. Well, thanks again for joining us today. And hopefully today what you've learned is the differences between valuations for tax and financial reporting purposes and requirements for these valuations. Certainly going over the costs of non-compliance and looking at the valuation process and methodologies for these 409As. I will add that there's maybe a little bit more cavalier attitude towards valuations these days. The value of a properly done 409A is not immediately apparent. I can say that our audit clients, Nadia occasionally has the unpleasant task of rejecting valuations when they're just not done properly, and there are definitely consequences down the line for a lot of these clients. It does come up most obviously in S1 filings, any public filings. That's an easy one, but the reality is most of our clients are going to be their exit is going to be through an M&A transaction, and even a company that isn't audited can often find themselves with one of the big four auditors of the larger entity that's acquiring them, all of a sudden going through their financials and through their compliance issues. We have seen this come up recently. I think it was about 2 months ago. We had a client who was about to lose a strategic investor based on a valuation done in 2011, where they issued preferred at 45 cents and granted options at a penny. We think that most people want to avoid that type of excitement. And we do have another webinar that we'd like to invite you in the future to actually discuss the defensibility of 409A reports. Again, thank you for joining us, and feel free to use this as a resource for any valuations related questions. You have our phone numbers, our email addresses, and we're happy to help when we can.
Great, and this is a reminder that you will be receiving a link with your CE credit certificate and the PowerPoint slides and recording of this webinar. So you will be receiving that within the next 3 business days. So thank you for joining us at Armanino today.